So, welcome. So today, what we're going to do is talk about a project, a really, really big project that we're starting to develop models where we can do both fiscal policy and macroprudential policy in the same uh, framework and so on. And so this summer in the summer school at Diligent, we're going to be looking at a model that has endogenous money creation, and we're going to be looking at another model that where we can study fiscal policy, but nobody has a model where we can integrate that analysis. And of course, we're going to first start off by showing why it's really important to be able to do that, because there is a very good chance that we will have a fiscal crisis over the next 5 years that will turn into a financial crisis. Or, as we're going to show, it's possible to have a financial crisis over the next 5 years that will turn into a fiscal crisis, and so on. So let's start off with a little bit of motivation. So, the Central Bank of Armenia, in collaboration with the Better Policy Project, has developed the second generation of the prudent risk management approach to monetary policy. In other words, to think about analysis to implement policies of least regrets, or what Olivier Blanchard refers to as avoiding dark corners. That basic analytical framework builds upon years of experience of developing the first the three essential and what distinguishes.
You are breaking up, Doug. We can't hear you anymore.
Can you hear me now? Hello?
Yes.
Can you hear
Yes,
me
now
now?
I can
Yes,
hear you.
yes.
Yeah.
So it turns out that basically just organizing uh, your work into those three essential ingredients allows you to make a tremendous amount of progress, as we've seen in all the central banks that have developed those FPAS Mark 1 frameworks. So COVID comes along, it's missing the idea of uncertainty and non-linearity and guarding against dark corners, or in the case of New Zealand, implementing policies of least regrets and so on. And so we built a framework with the Central Bank of Armenia, and now it has been launched in January of this year, and they've been implementing it over the last 6 months. So you can check out the monetary policy reports. The last two, one is March, and the one was just recently released. So you can understand what the prudent risk management approach means in practice. Next step, obviously, is to extend that to other countries. So we're working with the National Bank of Georgia, working on a slightly different variant of the prudent risk management approach, because we have an institutional framework in Georgia that has a governor decision maker model. So that's FPAS Mark 2 for monetary policy. The next step is to develop a framework that we can also use for thinking about fiscal policy and policies to guard against financial instability. So we have this theory that we've been talking about, which which hopefully will motivate why we need a better analytical framework for both fiscal policy and for macroprudential policies or policies to avoid financial instability. As a bit of motivation, uh, we can look at what happened when the advanced economy central banks, the Fed, uh, combined with an expansionary fiscal policy during COVID, resulted in a big increase in the money supply. In other words, a big increase in credit that was sufficient to raise asset prices enormously. So the S&P from the end of the first quarter of 2020 up until the end of the first quarter of this year increased from about 5,000 to 10,000, and more recently has gone up to about 10,500. That doubling in equity prices combined with approximately 50% increase in property prices or house prices, that combined with an increase in financial saving in the early stages of COVID, that was motivated obviously by precautionary motives or simply because consumers couldn't consume what they wanted to consume. They couldn't go to restaurants and take vacations, for example. So the combination of all those things on the total U.S. household balance sheet was more than staggering. It was truly humongous. The total amount of assets of the U.S. increased by $53 trillion. To put that in perspective, U.S. GDP in 2019 was $21 trillion. So the idea that you would have expansionary policies that would inject that much money into the economy, that would result in that movement in asset prices and that magnitude on the U.S. household balance sheet is very problematic. Now, the good news, or at least some people think this is the good news, is that the government or the household liability to GDP ratio hasn't increased that much. Okay, and I guess that is good news, unless one understands that the empirical work that Miriam at the National Bank of Georgia has found that this measure of wealth constructed from the U.S. household balance sheet combined with disposable income, which is always featured in our best consumption functions, is fitting again. And what that means is that the massive increase in wealth that we've observed is the reason why consumption has continued to remain strong in spite of the 500 basis point increase in the Fed funds rate, in spite of the fact that bank lending standards have increased fairly significantly, like enough that if we compared it to past recessionary episodes, that we should have expected a recession last year. And of course, there was no recession. Well, why is that? Well, simply because this increase in wealth is supporting consumption. And as a result of that, we haven't observed recession yet. Now, the underlying theoretical framework that we're going to talk about is based on the idea of endogenous money creation. And as we get into the second part of the presentation, where we go through a model with endogenous money creation, we will see that there is a very important new equation in the model called the financial constraint, which effectively you can think of as something that drives the demand for loans in the economy. And so it's based on this idea that money is not created by banks collecting a bunch of deposits and then lending them out, but the exact opposite happens in the real world. When people walk into banks and ask for loans, let's think of them as mortgages. The second that the loans are granted to these customers, that gives those customers purchasing power to go out and buy the house that the mortgage is being obtained for. And when that happens, one can understand what the direct effects of that are, because the direct effects are getting the money from the bank and paying for the house. The problem is that we don't know what happens next. Next, the person that gets the proceeds, who sold the house, can either purchase consumption goods, investment goods, or they can buy existing assets. And of course, at the prices that are also existing. So that is what money is used for in the economy. And if it's used for that, and we don't truly know what happens next in the with that money, we do understand the implications from understanding that financial constraint. In other words, we understand that if we observe high levels of nominal consumption or high levels of nominal investment, and if we observe extremely high asset prices, we know that enough money has been injected into the economy to support those prices and those quantities and so on. So the fact that asset prices have increased so much is a reflection of the amount of money that was injected into the system during that period when policies were very expansionary. So $53 trillion, what does that mean in terms of disposable income? Because obviously the money that was injected also increased inflation and so on. So if we look at it as a share or as a proportion of personal disposable income, we can see that since the first quarter of 2020 up until the first quarter of this year, it's effectively doubled. So so there was a bit of inflation that ate away at that $53 trillion increase, but not enough to prevent a doubling in the asset to disposable income. If one looks at the net on a net basis, household net wealth, assets minus liabilities, also increased by $53 trillion. So the point that we are in a very difficult situation. Are we having problems with the internet again? Okay, you can still hear me. Okay. So the chart that we're looking at is based on this idea of there being a corridor. When we look at the chart, it's being expressed in terms of Italian bonds. And the reason that we chose the 10-year Italian bonds is that we, of course, have the European debt crisis in the sample. So for those not familiar, we had a global financial crisis in 2008, 2009. And a couple of years later, we had the European debt crisis. During the European debt crisis, if one is going to think about that in fiscal crises in general, one just needs to look at the work of Eric Leeper and some of his students. You can find this work in YouTube videos on the Better Policy Project YouTube channel. But the basic idea is this: when there's a perception that governments won't pay off the debt, or that they might inflate the debt away, then bond market participants demand a high term premium. In other words, they demand compensation for that risk, the risk of of interest rates potentially rising in the future because of concerns about inflation or the risk of outright default and stuff. When you look at the chart that we're looking at it on the screen right now, you can see that of the European debt crisis are based on monthly data. The 10-year bond rate went up to 7%. Now, how to think about that? How is that related to the probability of a fiscal crisis? Well, if a country has the levels of debt that we observe in the real world right now, like U.S. is a good example because their debt GDP ratio is currently approximately 100%. If the interest rate on that 100% were to be 7%, so the interest payments would with the 7% interest rate, this would require a big adjustment in the primary balance. In other words, they would have to reduce government expenditures and raise tax. Would government be able to do that? And if the market's assessment was that they would not be able to do that because of polarity, in the case of the United States, you can think about it as, what are the chances that the Democrats and the Republicans would get together to come up with a plan that would cut expenditures substantially and raise taxes substantially? So there's this corridor part of the corridor theory of that is a function of both the level of debt and the projected growth rate of debt in the future. In other words, whether or not the debt is viewed as being explosive, and whether or not you have the to bring people together to make these really difficult choice expenditures and raise taxes and so on. So to a situation when we observed a fiscal crisis reasons, we would almost certainly and instantaneously have a financial crisis. And the organization of the financial system, the regulation of the financial was based on this idea that debt banks are holding a lot of this debt on their balance sheets. If there was an increase in interest rates, so the first effect would be that they would suffer mass capital loss on their bond portfolios and so on, and as well as their loan portfolios for those types of loans that were made. Long-term loans, like during COVID, for example, there were some banks that made 30-year mortgages at under 3%. So they've already suffered big capital losses on those loan portfolios because mortgage rates have doubled and so on. So the idea that interest rates could go higher, and if we had a fiscal crisis, that would probably almost certainly result in a financial crisis immediately. So that's how we get the financial crisis on the upper side of a corridor. Of course, on the concern about the effect of lower bound on interest rates, we get it there because if there is a threat that interest rates are constrained by the lower bound, there has to be some alternative policy that comes in to effectively replace the space that's been lost, the interest rate space that's been lost by hitting that effective lower bound. Then, of course, the policies that have been used to affect, and while they will eventually work, they will have these unintended consequences of raising asset price bubbles and making them certain that if the global economy or any individual economy gets hit with shocks that pushes us to the effective lower bound, we have to be concerned about what we'd refer to as Fisherian deflation, sort of Great Depression dynamics. But of course, if we deal with that with expansionary fiscal policy and expansionary monetary policy through QE, the problem with that is we get a lot of government debt and we get a big increase in asset prices. Is that if we're successful of escaping from that lower bound trap, we then end up with these really high asset prices and a massive level of government debt that then, of course, makes the economy riskier and, of course, prone to situations where there might be stagflationary shocks. One can imagine many different types of sources of stagflationary shocks these days, but if we were to observe some stagflationary shocks, that would require higher interest rates. And if monetary policy was constrained because the Fed and other central banks knew that they couldn't raise interest rates above some level, that would then, of course, result in inflation bias. And that inflation bias would then, of course, be incorporated in term premium like it was in economies before we tackled inflation in the 1990s. There was really, really high term premium built into longer term interest rates because people had been burned by the inflation of the 1970s and so on. So we hope that is motivation for why we need a new analytical framework that incorporates both fiscal policy and banks, okay, so that we can study the interaction between fiscal dynamics and financial crises and so on. So where does that take us? Well, in the second part of the presentation, we want to talk about what we think is a good starting point for developing a more comprehensive model that incorporates these two features that we think we need to guard against future financial crises and fiscal crises. So the paper that we're going to be referring to is a paper in 2014 where we developed this model called MapMod. The short part of the story is going to be that this model provided a very rich analytical framework for thinking about macroprudential policies, but we did not, one, integrate fiscal into it. And the second problem with the modeling approach is that it was based on infinite horizon setup. And obviously that is not rich enough to build a general model that's going to be useful for both fiscal and for financial stability or macroprudential policy modeling and so on. But we're going to go through that. One of the reasons that we're going to go through that is to understand the possible benefits from thinking about models with endogenous monetary creation and destruction for everyday work, everyday understanding about what is going on in both the global economy and in individual economies. So the two papers that we're going to focus on are one that has all the theoretical constructs and equations and so on, and then another one that actually goes through the applications and tries to emphasize the intuition for what's going on. The model is based on endogenous money creation and not the loanable funds model. So the loanable funds model, again, is based on this idea that you'll find in many textbooks still to this day, that the role of banks is to collect deposits and then to lend them out. So again, that's not the right way for thinking about how this stuff works in the real world. But not only is it not the right way of thinking about it, but thinking about it that way is dangerous, can lead to underestimation of the risks of financial crises. Because if one thinks about it that way, we're missing out all the potential roles that banks' perceptions can have, and in fact, generally, everybody's perceptions about whether or not the financial system is stable or not. So in the model with endogenous money creation, the banks are going to make loans on the basis of whether or not they think those loans are profitable and whether or not they believe that people are going to pay off those loans and so on. And so obviously there are perceptions of the amount of riskiness in the economy, or the riskiness on their loan book is going to be very important in their decision about whether or not they make the loan, give the credit, and allow the money to be created in the economy. Now, of course, another important aspect of that is that money can be destroyed if banks lose their confidence, or the general population loses their confidence in the financial system. Then banks can stop making loans, and when they stop making loans, the money supply can actually contract. And of course, this is really, potentially dangerous, because if we generated this big asset price bubble, and if that asset price bubble is based on optimistic expectations, or underestimating risks in the economy, then we could be setting the economy up for another financial crisis and so on. So this model called MapMod Mark One was designed to study the combination of the risk to excessive credit expansion and asset price bubbles. That is, the empirical evidence. When one looks at all the banking crises that we've seen in the past, every one of them was associated with an excessive credit expansion and asset price bubble. Now, the second point is very important, because the focus that we're going to have in this discussion is going to be looking at the asset side of bank balance sheets, but the liability side of the balance sheet and the risks associated there are more to deal with liquidity issues. So thinking about bank runs and things of that nature. Now, all that stuff is very, very important, especially once the crisis gets going. Okay, so I don't want to underestimate the importance of the liability side of the banks, the commercial bank balance sheets, but that's not going to be the focus of attention here. What we need in any future model, we're going to show you in this model, to be able to study macroprudential policies, we're going to need to be able to explain these nonlinear interactions between the borrower balance sheets, the bank balance sheets, and the real economy. And that's what we're going to show you a model that basically does a good job doing that. So that's effectively, replicating, the historical financial cycles that we've seen in the data. So what are they? They start off in a boom phase where these risks gradually build up over time. So debt obviously is a stock, and so it will take years for the leverage to build up to the point where it is really risky. If that leverage is associated with making loans to people who buy houses and push up property prices, then you have what is referred to as the dangerous combination of an excessive credit expansion and asset price bubble, and that increases the probability that the bubble might come to an end. Okay, so MapMod was designed with that in mind, and as I'm going to show, since it captures the basic features of financial cycles, and is not simply just a forecasting model, but a model that has instruments in it, like capital requirements or loan to value limits. One can consider the use of those policies, such as countercyclical capital buffers, and then ask what are the long-term implications of imposing higher average levels of minimum capital requirements, for banks' balance sheets. So, in this modeling framework, we can study the risks of financial crises and how we might avoid them with certain policies. And of course, if those policies involve, as we're going to show, increases in the average cost of capital permanently, that's going to reduce the capital stock and so on. So there's a very important trade-off between the riskiness of the economy and the average level of potential output and consumption in the economy. So what are the basic features of financial cycles? Well, the empirical literature suggests that the seeds of financial crisis are sowed well before the crisis breaks out. The best two variables for predicting past, I emphasize past, financial crises were the combination of high credit growth and property prices. Another very important aspect of this problem that we want to capture by the model is that it's extremely difficult to identify credit bubbles and these excessive credit expansions and asset price bubbles in real time. So we're going to try and motivate why, on the basis of our standard macro aggregates, why it's very difficult just to use those aggregates to predict that a crisis is coming. And the reason for that is that with financial development, leverage tends to trend up over time, and therefore it's very difficult to distinguish between good credit expansion and a bad credit expansion. And we'll talk about some of the implications of that. We're going to focus initially on some data that are really nice for zooming in on the problem or the problem that was in existence before the global financial crisis. So this is going back to data that for the UK, where we look at the loan to value ratio. And so the basic idea is that a standard mortgage contract, you have to put a down payment down. And so if you have a loan to value ratio of 95%, that effectively means that you're putting 5% down payment down on your property and so on. And so when you looked at the loan to value ratio, the size or the volume of these circles, that represents the amount of the new loans. On the vertical axis, you have the spread in other words, the rate on those mortgages minus the bank rate. And the idea there is that under endogenous money creation, the bank makes profits if by having a higher interest rate on loan than it has on its liabilities. So you can think about that as its deposits and so on. So the idea is that the deposit rate in the economy sort of moves with the bank rate. So that spread between the loan rate, which is on the asset side of the commercial bank balance sheet, and the rate on the liabilities for what they have to pay. So that has to be higher for obviously the bank to be making money on its loan portfolio and securities portfolios and so on. So look at that green, and it looks pretty flat, and that is what the problem is, that there was not any risk premium built into these riskier mortgages that had high loan to value ratios. So what happened? Well, we had Lehman's on September 15th of 2008, and the economy, the global economies, all economies in the world went into a crisis. And of course, some of them had problems in their financial systems because you had these excessive credit expansions and asset price bubbles, and because of underpricing of risk. So the very first thing was the economy became a lot more risky, and as a result of that, banks stopped making risky loans. They realized that their loan portfolio was excessively risky. So you can see that the magnitude or the volume of the little purple dot shrinks relative to the green dot. And that's because banks were trying to improve the quality of their balance sheets, the quality of their loan portfolio. And of course, to repair their balance sheets, they also required a higher interest rate or a higher difference. And of course, to repair that balance sheet, when it's suffering a big losses, that could take many, many years to repair, either by reducing the loan supply of risky mortgages or by demanding a higher interest rate on it. So what happens as the crisis unfolds and we move from 2009 to 2010, so the economy is recovering and so on. So the amount of loans that are being given to households and stuff increases along all the risk segments. So you can see that the purple for high loan to value ratios of 95%, the amount of volume of loans increased as the economy improved. As the economy continued to improve, then we observed the same idea. The slide that we're looking at on the screen is simply to compare the difference between the loanable funds view that you will find in textbooks still to this day, and this endogenous money creation view. And there actually are some financial institutions in the world that where the local funds model is appropriate. Those are institutions that actually collect people's funds and they lend them out on behalf of the. So these would be, for example, if you have an account at a mutual fund or there are certain funds that for pension funds and so on like that, where you could deposit your money and they will you can choose a portfolio and they will lend it out on your behalf and so on. So there are loanable funds models or banks in the in the real world, but they're not commercial banks. and they're not the banks that are responsible for creating the money in the economy that we actually use, or most of the money in the economy that we actually use. So the way that endogenous money creation works, instead of thinking about banks that collect deposits and then lend them out, and through that process increases money, the exact opposite happens when people come in and ask for loans. Through the process of granting those loans, money is created and circulates in the economy forever until someone decides that they have too much debt and they want to reduce the amount of loans in the economy and so on. So that's the way that it works. Now, it obviously works that way when one thinks of the global economy, because investment has to be equal to saving in all models and so on. If we have a model without banks, and if there is a shock that raises, for example, future productivity growth, current and future productivity growth, which is going to be a very dominant shock for driving cycles in the world economy and many economies. In a model without banks, that would be very problematic because the consumers would see all this future income. The businesses would realize that the productivity is increased, so they would want to invest to increase the capital stock. So you're in a situation where consumers want to consume more, businesses want to invest more. If the economy is at full employment, our general equilibrium theory tells us that the real interest rate has to rise to effectively encourage consumers to save to finance the investment. Okay. So the problem with that story is that it's very difficult, almost impossible, to explain this very strong positive correlation between consumption and investment. And of course, it's trivial to explain this correlation between consumption and investment when one has endogenous money creation, because if people view higher productivity today and in the future and want to consume more today and invest more today, obviously if banks give them the credit to finance those expenditures, those consumer expenditures and that investment and so on, this is what facilitates and allows consumption and investment to move strongly together globally. And of course, that's much, much more difficult if somehow you don't have those banks providing the credit. So it's much more difficult and problematic in models that don't have endogenous money creation. Now, what happens in this story? Well, sometimes the modern financial system can do magical things for us. So, for example, if people realize that they're high productivity growth, they're in a high productivity growth world today, maybe because of artificial intelligence and so on. Well, the advantage of having a modern financial system where banks can make loans to people is that it allows people to get to the new steady state with higher levels of consumption and output much faster than in your old style general equilibrium model, where basically the households would have to save sufficiently to finance the investment to get that higher level of output and consumption. So our modern financial system that lends money to the economy and provides sufficient money to it can result in a virtuous credit cycle that gets us to the new steady state with higher levels of consumption and output faster. Now, the problem is that because this all depends on perceptions by banks and other people in the economy, they can obviously get it wrong. So if they think that they're in an environment like was the case in almost all financial crises. So after financial crises, there were what is referred to as permanent scarring effects. In other words, there were long-term downward revisions in output and income and consumption in all of those economies and so on. And so one reason for financial crises is obviously underpricing of risk, but another one is that people's expectations of the fundamentals were simply too optimistic. So in this story that we're going to be telling you, perceptions are really, really important for fueling the financial bubble or the boom phase of the financial cycle, but they're equally important if everyone gets it wrong, underprices risk, or too optimistic about the future, leverage builds up excessively, and now the economy is at risk of a financial crisis. So I explained this to you a little bit earlier in the first phase of this discussion. So one aspect of the model that is new is this demand for loan equation. And this demand for loan equation is really, you can think of it as a demand for money equation, because again, when you make the loan and give the money to the person to go out and buy the house and so on, we have to figure out, how much would that demand for loans be, and to think about that, because effectively you're asking, what is the demand for money in the economy to provide enough money so that the economy can function smoothly. One has to think about what money is used for in the economy. So the first term in the expression is consumption expenditures. So we need money to buy the goods and services that we consume, and of course that depends on the price of those goods and services. So the first thing that we use money for is to buy consumption goods. Well, same thing with investment goods. Somebody has to buy investment goods, and when they buy investment goods, they use money. So money, the amount of money in the economy has to cover those expenditures to buy investment goods. The third term is the one that we should be particularly worried about now because of what I said in the first part of this presentation. The economy has been provided with enough money that is allowed equity prices to double, property prices to increase by more than 50%. And that is very, very problematic because that potential bubble, at some point is exposing the economy to risks of it potentially bursting. So the money is used for all those things. Well, one way to think about our money that we use for those things is to look at how many deposits we have at the beginning of the period or the end of the last period. And then, of course, if we destroy money or we destroy our loans, that would result in a negative amount of loan demand, because some people want to repay their loans. And then, of course, that expression would then tell us what the demand for loans is. So that's how we think about debt and money in the economy, that people need it to buy things, the things that they want to buy. And once you figure out what it is they want to buy, that requires loans. So people can't buy houses unless they get a loan from a bank. So that financial constraint is, I think quite insightful, and will have to be a part of any new macro model that we develop. So I'm going to skip ahead a little bit because this is going into a bit too much detail. In the third part of the presentation, we're going to talk about what's wrong with this model, this analytical framework. And the answer is that to a large extent, it's because it's based on infinite horizon modeling. And two, it doesn't have enough heterogeneity and so on. So I want to tell you a little bit about this model, which is a standard DSG model based on the infinite horizon framework and so on, where you basically don't have very much heterogeneity in households and so on. So what is going to go on in this model? Well, borrowers are going to use these bank loans to finance consumption and investment expenditures. They're going to borrow against the value of their assets. Okay, so in this case, we can think of it as physical capital or housing or stocks, their equity account. The individual defaults of each household that have borrowed are going to be a function of these ex post asset prices. So think of it as you take a loan out and buy a house with a 5% down payment. And so if something really bad happens and the price of the house falls by 20%, well, if you only put 5% in it, now you have negative equity in the house. Okay, so the idea would be that why would you keep the house? Why wouldn't you just default on the loan? So that's what we mean by individual defaults of the borrowers are a function of the ex post asset prices. So bad states of the world, when house prices are low, that results in people defaulting. These individual defaults are going to be driven by two types of factors. They're going to be idiosyncratic factors, so just random things that are common across the economy and so on. And then, of course, the common aggregate factors. In the approach that we're following here, it's a critical assumption, which I think is really easy to defend in the real world, is that obviously you can't diversify all this risk off the bank balance sheet. So that when banks do these risky loans, they can't find somebody in the economy that will provide insurance against that risk. And that is actually quite easy to defend, because when a financial bubble gets so big, there is nobody in the economy that could pay off everyone in the event of a bad state of the world happening and so on. So banks are going to hold these loan books, not trading books. Banks' ability to expand their balance sheets are going to be limited by capital regulation. So we're going to have a minimum capital adequacy ratio that's going to be applicable to the ex post realized value of assets, liabilities, and equity. 8%, the number under Basel, is what we're going to be using here. The banks are going to make two types of decisions. They're going to assess these borrowers, which effectively is assessing the quality of their assets, and other individual. And they're going to assess these borrowers, and then they're going to offer them lending supply curves. So effectively, they'll give them the choice. Do they want to choose a point on the curve that has a high leverage or lower leverage? And obviously, the riskier loan is going to require a higher interest rate. So that's what they're going to be doing in terms of dealing with borrowers. The banks are also going to look at their entire loan portfolio and look at how risky that is. And of course, what is the risk capacity of the bank capital? In other words, if they're close to the minimum capital adequacy ratio, they're going to probably want to not make the loan and try to improve the amount of capital that they have in their own bank. So I'm gonna explain this in charts so that one can understand the intuition about what's going on here. There are going to be two fundamental nonlinearities, and we're going to need both of these nonlinearities to be able to generate the results that we're going to generate. In other words, to be able to generate what the empirics of financial crises are, which are that the seeds of them are growing well before the crisis breaks out. And so that's going to be over a long period of time where risk has been underpriced and people's expectations are too optimistic. And as a result of that, we're going to be in these flat parts of these curves, okay, where we can see that basically we have very, very low lending spreads and so on. And when there's an increase in leverage or the borrower loan to value ratio in this flat part of the curve, it doesn't require higher spreads. So that's, for example, the data that I showed you before the crisis in the UK, when we looked at the interest rate spread there, and of course, the quantity of lending was really quite high. Okay, so that was again the bubbles that I showed you when we started the presentation, going through the empirics. Well, the problem is that if one goes into a financial boom phase, where basically leverage is building up and property prices are building up, and then of course we reach a point when people realize that there has been underpricing of risk. The curve is basically going to shift back and so on. So when risk is being underpriced, you're offering more and more loans at really low interest rate spreads. And that, of course, will then shift the amount of that curve on the left, what is referred to as the augmented Bernanke-Gertler-Gilchrist financial accelerator. It shifts it to the right. And the argument that we're going to use here is that we don't want to linearize these curves as is done in most modeling applications and so on. Now, what are the problems? Well, that curve can shift out like it did before the global financial crisis, and it can also shift back if people's perception of risk become more realistic. So that's your standard Bernanke-Gertler-Gilchrist financial accelerator, but the only difference is that we haven't linearized it. So we have this idea that at some point, when the loan to value ratio rises above 100, for example, then obviously banks would not make those loans, or they would charge a really, really high spread on extremely risky loans. The curve on the right-hand side is based on the notion that banks want to stay away from this minimum capital adequacy ratio. And why is that the case? Well, because if banks do get close to that minimum capital adequacy ratio, the financial regulators will visit them and impose restrictions on them to improve the quality of their balance sheet and so on. And of course, banks don't like that. They don't want to be in a position where they have to change their business models because they've taken on excessive risk on their bank capital and so on. So there's another very important non-linearity that's going to be important for the results. Now, this entire environment is going to be built on one fundamental driver of economic fluctuations, which is the perceptions of future productivity growth. So if you think that you're in a high productivity growth world, like people thought before the global financial crisis, so for example, in the United States, potential growth had been revised up a full percentage point for several years before the global.
Doug, I think your internet connection is cut off.
Yeah, that's right. We can't hear you.
Are we live again? We seem to have broken.
Yes, we
Can you
are.
hear me?
Yep.
Okay. So let's just go back a sec and redo this and redo where we were because I wasn't sure where it stopped. But the point I was trying to make here is that perceptions of fundamentals are very important. So if one looks before the global financial crisis in the United States, for example, underlying potential growth had been revised up a full percentage point. So I'm talking about several years before the global financial crisis. And it was those perceptions of high productivity growth that obviously were one important factor that was driving strong consumption demand and investment demand for housing and so on, because obviously people thought they were going to be there was going to be a lot more income in the future. They wanted to consume some of that income now and so on. And that's standard for many economies that have gone through financial liberalization and have these modern financial systems that allow uh, households and business to borrow against the future and so on. So this is going to end up being a very important part of the story because this allows us to explain why we can have a virtuous credit cycle and why we can have a very dangerous credit cycle. And so in the very first scenario that we do is we consider the effects in an open economy where output is approximately 10% higher. So if one thinks about expected productivity growth being higher enough to raise GDP growth by 1 percentage point per year, then the effects over a 10-year period would approximately be 10%. And so the lines that we're looking at right now, you can see we have years on the bottom axis. Model is actually quarterly, but just to make the graphics easy, we're plotting the annual numbers of the variables. So when we look at that first line, we're considering an experiment where people believe that productivity growth is going to be higher, in this case, in the traded goods sector. And this results, the shock is big enough, the revision to productivity growth is big enough that it would change output by approximately 10% after 10 years. Okay, so approximately 1% a year. But as you can see on the left-hand side, the line is not linear. GDP picks up even faster than its long-term growth rate. So there's a cycle in both consumption and investment a little bit. And this, again, is because of endogenous money creation. If people see these higher productivity levels in the future, businesses want to invest. They need to build up capital to get the full benefits of the higher productivity. And at the very same time, consumers want to consume more because they're richer. They have higher productivity growth in the future. And as a result, in our modern financial system with banks, this facilitates the financing of both consumption expenditures and investment expenditures and allows us to get to this higher level of consumption faster. Okay, so that's the good news. So the first column, we have GDP, consumption, investment, which is the story that I was trying to tell you. On the last column, we have the bank variables. So you can see how banks respond in this kind of environment. So the first thing is that they give credit to the economy that's sufficient to generate those paths for GDP, consumption, and investment and everything else. So you can see that there's a pretty strong upward trend in real credit, okay, to finance all this activity. The second row in the last column, we have the lending spread because they think that they're in this environment where these loans are going to be really, really profitable. They make the loans available at very competitive rates. So in other words, the lending spread declines initially. The bottom right-hand side, last column, last row, we have the post-default capital adequacy ratio. Remember, this isn't a very important part of the model. Because of the riskiness of these loans, and because we've set a minimum capital adequacy ratio of 8%, okay, so you can see in the bottom graph, the chart starts at 8% and then goes up to 11.5%. And you can see that the line starts approximately at 11.5%. It's actually 11.4%. So that is the buffer that the banks are holding before the shock arrives because of the riskiness on their loan book. So not only do they hold 8%, the minimum capital adequacy ratio, they try to keep a buffer of about 3.5%. Now, again, in this environment with people expecting really high productivity growth in the future, the banks are prepared to reduce that buffer a little bit because it has all this the possibility of making all these loans to people that, of course, are going to be really profitable and stuff. So the banks are quite aggressive as they are in the real world of expanding credit when they think people will pay it off and when they think it's profitable. The third column shows that the economy is going into debt. So net foreign assets as a share of GDP declines over time. In other words, they're becoming more, if they were a debt creditor, a debtor country, they'd be going into more debt. In this particular case, we're just measuring it as a net foreign assets, so it would be negative and so on. So you see the economy is running current account deficits and either reducing its net foreign assets or increasing its net foreign liabilities. The capital stock is rising over time. If you look at the bottom row, you can see that equity prices are rising because when you look at the real value of the capital stock, which is the real value of the physical capital stock, it's obviously increasing in the short run because in the very short run, the capital stock, the physical capital stock is fixed and so on, and can only rise gradually over time. It takes time to develop real capital. As a result, the value of capital increases in the short run until more capital is available and so on. So the standard Tobin Q type of an effect. The second column, which I'm not going to talk about very much because I'm not focusing on monetary policy today, but kind of deeper, bigger kinds of issues at this point, are basically the variables that are relevant for monetary policy. So we have wages, prices, and the policy rate. So that's the so the bottom line there is that this is an example of a really good credit expansion. Everybody in the economy knows what's going on. They all expect higher productivity growth, and it happens. Nobody's surprised. We get to the steady state, the new steady state with a higher level of consumption, investment, faster, thanks to our modern financial system. Now, the only problem with this is, what if it turns out that higher productivity growth that people had assumed was going to be permanent? What if it turns out that people's expectations were too optimistic? And so to mimic this kind of situation and to get the charts looking good, in other words, charts so that you can see the basic insight of the model, which is that it takes about 3 years to develop enough leverage. In other words, for people to be wrong about things. And so in this experiment, we're going to assume that over the first 3 years of the high productivity scenario, that everything works out perfectly. Okay, so that you can think about this as what happened before the global financial crisis and most financial crises. So there's some period of time where people were optimistic about things. And of course, as I showed you, if one believes that the productivity growth is going to be permanent, and so that's the blue line, along that path, one is building up houses, taking on leverage, and so on. And so if one learns after 3 years that basically those assumptions about productivity growth are incorrect, that people were too optimistic. So what happened to the economy in this case? And so the red line, you can see the red line and the blue line are exactly the same up until the 4th year. In the 4th year, they realized that the productivity growth was too high. This happened again during the global financial crisis. Productivity growth was revised down substantially and so on. And part of that reason was the scarring effects of the financial crisis. But another reason is that people were simply just too optimistic about future activity prospects before financial crisis and so on. And so the thing that I really want you to look at here is that the model, despite the fact that those two nonlinearities that we're referring to earlier are these nice, smooth, continuous, and differentiable functions. So even though we have these nice, smooth, and continuous differentiable functions, we can still get behavior that looks like a crisis in the sense that the economy can experience a crash. You can see that in terms of GDP, output falls dramatically and has to be below its steady state rate for some period of time, and so on. So we can see in this chart that we would also get a correction in asset prices. So this is the real value of the capital stock would also experience a big drop. Well, how would this actually work in the model? Well, what happens is that banks cut back on the supply of credit and loans, and they also demand much higher spreads or interest rates on those loans, much like what we observed during the global financial crisis. So the banks are trying to repair their balance sheets by reducing the amount of leverage and so on. And they're also basically charging a higher interest rate on that to try to build up the capital in the bank and so on. So just when the consumers and the firms need credit, they're being cut off from it, or they're being charged a higher price. So that's the situation where things are being driven by excessively optimistic productivity expectations. The thing that I want you to focus on here, which of course we would need to focus on in a better model, and we're going to talk about what the characteristics of that better model would be the quantities of, or the magnitudes of these numbers right here. So you can see that this financial cycle at the beginning of the fourth year, we can see that output goes from about 4% above what the original steady state was to about zero. So we've got basically a 4% swing in output. Now, financial crises are bigger than that. Okay, so obviously this shock by itself is not sufficient to explain what happened during the global financial crisis. And of course, that's good news because there were other things that happened during the global financial crisis, such as the underpricing of risk and so on. The other thing in terms of magnitudes that we want to point out here is that despite the fact that asset prices fall, they don't fall very much. So asset prices in the real world tend to fall by much more than that. And that's another indication that this cannot be the only shock driving everything. So a shock that I think most people would consider to be their first choice at thinking about any financial crisis. Why would banks allow an excessive credit expansion and asset price bubble to exist? And obviously, it's because they're underpricing risk. In the United States, these loans were referred to as ninja loans, or loans where the people had no income, no job, or no assets. So at the very extreme part of underpricing of risk, you have things like what happened in the United States before the global financial crisis, where effectively there was a lack of financial supervision. The loans were being granted to people that the loans simply shouldn't have been granted to people to. So obviously there was underpricing of risk, both direct evidence of of these ninja loans, as well as loans that were being made at extremely high loan to value ratios with very little compensation for risk and so on. So in this example, we're going to do something very similar. We're going to assume that these loans are underpriced for 3 years, and then starting in the 4th year, people wake up and realize that the loans are being underpriced. And so you can see that what's interesting here is that the qualitative magnitudes mimic exactly what we just looked at when we had overly optimistic expectations of future productivity. So when one looks at the boom phase of the financial cycle, in this case, output, consumption, and investment rise. Well, why? Well, because banks are underpricing the riskiness of the loan book, and so they're giving credit, debt to the economy, which is obviously injecting money. Lending spreads are low, just like they were in the situation where people's prospects of higher productivity growth were optimistic and so on. Banks are eating into their buffer because the riskiness of loans or the perceived riskiness of loans have gone down. They reduce the amount of capital buffer and so on. Real value of capital increases. Debt increases. In other words, net foreign assets fall. So everything qualitatively is behaving in the same way as when we had the increase in productivity growth. And when we look at the magnitudes that are associated with this reduction in risk, we can see that they're not very large. In other words, the effects on GDP are only a percent. On consumption at the peak, they're about 1.5%. On investment, they're about 2%. When one looks at the effects of lending spreads, they're quite small. During the boom phase, lending spreads are only 10%, or sorry, 0.1 percentage point lower. So what's the big deal here? Well, the big deal here is that even though things look very, very small, when we put together the combination of an underpricing of risk and allow these assets on the bank balance sheets, risks on those assets to build up over time. If we have a combination of this shock that doesn't change very much, plus the other shock, in other words, the downward revision in growth fundamentals, we get a combination of these two things. And that then, because of the nonlinearities, results in this very vicious interaction between the real economy and the bank balance sheets and asset prices and so on. So this is when we put the two things together. So now we're talking magnitudes that are like the financial crisis. So in this case, output is higher by 6% at the peak and then falls to 2%, minus 2%, or 2% below the steady state. So there's a swing during the crisis phase of about 6%. And so now we're talking about things that are roughly the right order of a magnitude for a crisis and so on. So I just want to stop there. And first, so this is the second part of the presentation that I'm going to be ending here in a second here. But when one looks at these properties and one compares them to a model without banks, the key insights, and these are key insights for understanding the economy every day, is that things can proceed, consumption, investment can boom, employment can boom, And that is all because the modern financial system is providing credit to the economy. And of course, when that works, things can work wonderfully. Of course, when there's a perception that there has been an excessive credit expansion or asset price bubble because of overly optimistic growth expectations or underpricing of risk, once people wake up, then and that perception changes, then one can generate financial crises because of these very nasty interactions between the financial system uh, and the real economy. And to look at what types of policies can be used to deal with the risks of financial crisis, and once they happen, to help also deal with those issues as well. I don't want to talk about that stuff because what I'd like to do is to talk about what's wrong with this modeling approach. And Timur, if he's still here, what our plans are to develop step by step over the next year or so. Okay, this project is in my career. This project will be the biggest and most ambitious project of my career. But in some sense, it will also mean sort of taking critical insights from work that I've done developing models based on infinite horizons that ignored fiscal policy, and as well as a whole bunch of work that Hamid Farouki and I started in the 1990s, developing overlapping generation models to think about fiscal policy. So, in some sense, this project, while it's extremely ambitious on the one hand, it would be foolish for us not to do it right now because we have, I think, most of the things that we need technically. We've got Dynair, Julia, so we've got open source code that is extremely efficient for solving gigantic models and so on. And plus, as I said in the beginning, there is a very good chance that we might have a fiscal crisis if we end up in a stagflationary world where interest rates have to be higher. So we need to build models that have debt, stock flow dynamics, and there has to be interesting interactions between fiscal and financial crises. And as I said, our standard financial crises also had very important fiscal implications because once people realized that output was permanently lower, they also needed to realize that the tax base was permanently lower. So in a lot of countries that experienced financial crises, they had big problems with fiscal. Now, maybe you could talk a little bit, Timur, about what we think the critical pieces are and what the approach that we'll take to building this model.
Yeah, sure. First of all, I would say that even though that this goal can be supposed as ambitious, but still, I think that it is implementable step by step. We will achieve it. And well, I absolutely agree that it is very important to consider a combination of fiscal and financial risks that exist in economy. And here, it is one of the tool um, that would allow us to consider it is something that is not non-Ricardian. So as you said before, previous models, they were based on infinite horizon decisions, and basically overlapping generation models, they can be more helpful here. Also, it is very important to consider banks as a specific block because first of all, we need to understand how it changes dynamics of the model. So why, what's new introduced in the model while there are banks. Heterogeneous model, heterogeneous agents, households, for example, some of them are poor and some of them are rich, is also another building block of this model that affects dynamics. And the core idea of that model would be the endogenous money creation. In your equations that you presented, it was clearly visible that money creation is just another side of debt creation, just another side of balance sheet. So it's very important to consider that also, especially when we're thinking about lending process. And loans are the main source of money creation in the modern economy. So it would be very important to introduce this in the model or develop. At least I think that in a basic setup, it is already implemented. And finally, returning to the beginning of this description, this fiscal policy considerations, especially when we have a finite horizon non-Ricardian world with banks. Well, I hope and I believe that this model will provide us some very important insights that are crucial in the current agenda, put it that way. So yeah, as I said, I think that it is implementable, and there is a huge need right now for this type of models and for this type of results from simulations. That's it.
I'm not sure if there's a problem with Doug's connection, but thank you so much for your summary, Timur. I feel like you kind of summarized the whole presentation and also gave us a perspective of how this model is going to be applied once you guys finish it in a year, hopefully. And it was a very interesting presentation. Thank you.
Thank you very much.
Thank you for having me.
Emma, are you responsible for the live? I think we can finish it now.
I am not, but I believe that if we all leave the room, hopefully the live will end. I
Yeah,
think
I
we should
think
just
so.
leave the room.
That's, I
Thank you,
guess,
everyone.
yeah. Thank
That's
you.
it for
Goodbye.
that's it for today, right?
Yeah, I
Yes.
think so. I
Okay.
think so.
Thank you, guys. Thank you.
Thank
Have
you
a
so
nice
much.
day.
Yeah,
Bye.
and let's stay in contact.
Absolutely.
Yeah.
Let's stay in touch. Let's keep in touch.
Good. Bye.